having a great weekend. This video is going to be a continuation of my last 3 videos. So I have created a playlist for you guys where I'm sharing my trading plan, which includes market analysis and then sector analysis and then stock analysis. And today's video is going to be very important, where I will discuss your position size. So how much of a share can you buy from a stocks that you have identified a potential buy, and how much could you risk? So as I've mentioned in my last video, that your position size should be directly correlated to your risk appetite, right? So you have to know that there is risk on each and every trade that you're going to make, right? So there is a risk. You have to admit that there is a risk, and you have to predefine your risk, and then based on your risk appetite you have to identify your position size. Now, of course, since I published my last video, within the last week market corrected heavily, right? Market corrected about 700 points, and it is currently trading around 17,000, and from the top it corrected about 1600 points, which is around 8.5% from the top. Now I'll have to reiterate the whole market analysis, sector analysis, and then stock analysis, because market is dynamic, right? I have planned something last week, and I cannot hold on to that plan if market changed, right? Market pattern changed. So we have to look at market again. We have to do sector analysis again. We have to do stock analysis again. But since we have already done that, I'll be pretty quick on all those analysis, and since we already know what is stage analysis, it will be pretty easier for us to understand the market pattern and the sector pattern and the stock pattern. Let's find out what is market's current pattern and whether we could buy, and of course we will also discuss about your position size and your risk appetite, and how much share can you buy based on your say capital. So if you have say about 50,000 capital and you want to invest something, we would share an example and show you how much share can you buy, how much can you invest. Okay, so let's jump into my screen and analyze further. Now let's look at the market pattern and see where it is trading. So market corrected about 738 points last week, which was about 4.16%, and it is trading closely around its 30-week moving average. The 30-week moving average is around 16,600. So 400 points above it. It is currently trading 400 points above its 30-week moving average. Now, based on the pattern, it still looks bullish, because of course this is a healthy correction from the top around 18,618. It corrected about 1,600 points, which is about 8.5%. So market corrected 8.5%, which is healthy. So of course it moved so much from the time of COVID-19. It moved so much upwards, right? So of course these are the corrections that we have to see. We have to live through these corrections for us to see the better future, of course, which is 19,000, 20,000, and above 20,000. Now there could be 3 things from here on. Market could directly break below its 30-week moving average, then we would call it stage 4, right? Or it could trade sideways and create stage 3. But still, the overall pattern, as you can see from here on, it is bullish. So the market, based on our stage analysis, it is still bullish, because we have analyzed and we have explained why it is bullish, because it is still trading above its 30-week moving average. So if it is trading above its 30-week moving average, and it corrected above its 30-week moving average, then of course it's still bullish. Now let's look at PSU Bank. So PSU, we have discussed PSU Bank and its breakout level, which was around this area, and it broke past of this level around the week of October 11th. And so based on the stage analysis, based on Stan Winston's trading methodology, when it breaks past of its resistance level, it has the tendency to come back to its breakout level. We have discussed that, right? So while it has break above its stage 1 to stage 2, it is coming down to its breakout level, which is around this area. So this is the whole PSU bank sector. So as per the structure, it is of course trading above its 30-week moving average, and it has just came down to its breakout point, which is not a bad sign, because it is trading above its breakout point as well as its 30-week moving average. The pattern, if you look at the pattern, it's still bullish, and because the relative strength also is trading above its above the Nifty 50 line, which means that it is outperforming the market, right? So see, market will correct time and time again. Market will correct because correction is healthy, pullbacks are healthy. If market cannot go up in one direction, so it has to correct back. Market was trading around 18,500 and it saw a level of 7,500 just a year ago. So it has moved up so much, right, beyond our expectation. So if we see some correction, we should not panic. So of course panic hits faster than greed, but of course based on the pattern, basically we are doing analysis, we are not predicting. Of course there is a certain prediction that everyone has to make, but we are depending on our technical analysis, which is based on Standard stage analysis. Now based on stage analysis, Nifty PSU bank is still it is still looking bullish, because it is currently trading above its breakout point as well as its 30-week moving average, right? So we have identified that the market is still bullish, and the sector, which is the PSU bank that we have identified, is still bullish. Let's look at media sector, and media sector is also trading above its breakout point, and the relative strength is also higher. So it is of course looking very strong. Now we haven't discussed stocks from the media sector in my last video, which I'll cover in today's video, because I'll quickly wrap up my sector analysis. So based on the sector analysis, Nifty media sector as well as the PSU bank sector still looks bullish, and still looks that it is correcting back towards its breakout point, which is of course healthy. Now we'll have to look at some stocks. So we have identified Bank of Baroda, Canara Bank, Union Bank, Indian Bank, and some other banks in my last video. So we will first look them up and see where they are at and where can we buy. And now we will discuss the most important thing that that was pending on my last video, which is the position size and the risk. So how much share can you buy of a given stock? If a given stock is looking healthy and you want to buy that share, now how much share can you buy? It is totally dependent on your risk, which we are going to discuss on this video. So please stay tuned. Let's start with the PSU bank that we have identified last week. Now, my last video was published when it was trading around 220, and I have explicitly mentioned that we should not consider buying around this area, because if market corrects to 500 points, we would also see some correction. So Canara Bank also saw a correction of 7.70%. If you would have bought it around 200, 220 or 50, it has corrected about 7%, right? So the breakout point, the breakout level is around 160, 170, and it is trading around. It was trading around 240. It went up to 250, and then it corrected around 200, right? So now, can you buy? Now let's discuss your position size, and based on your risk, of course you can buy. Of course, if you can consider buy this stock, because it is showing a good structure. But again, now let's discuss your position size compared to your risk assessment. Now, based on your risk assessment, if you were to buy around here, so let's suppose you want to buy Canara Bank at 200, right? And you're hoping for, of course, correction upwards, right? Because market has corrected quite a lot, and we are hoping for a correction upwards. So if you have to buy now, what would be your risk level? Your risk level has to be below this breakout point as well as this 30-week moving average. Now 30-week moving average is trading around 169. You can see the moving average point around here. So it is currently the moving average is around 169 and the breakout point is around the same. So your stop loss should be below this point. Now let's suppose if you have 50,000 and you want to invest in Canada Bank. Can you do that based on your risk? Now let's assume your risk appetite is 5,000. Okay, so you want to risk 5,000. So on 50,000. So that is a 10% risk that you're going to you wanted to take. So of course it's your risk appetite. How much you want to risk? It is totally based on what you want to risk, how much you want to risk. So your position size should always be correlated to your risk appetite. Okay. Now I will share the link here, which is the Brokerage Calculator. So Zerodha has this Brokerage Calculator which you can analyze when you're going to buy a stock. Now let me open up my calculator. Okay. So you have 50,000. Okay, and you want to buy. So you want to buy Canada Bank, which is trading around 200. So you want to buy Canada Bank at 200. Okay. So how much share can you buy? 250 you can buy. But can you buy 250 with your risk appetite? We have discussed your risk appetite is 5,000. Okay. So let's put the buy price. So here you have to put the buy price, and here the sell price means the stop loss, which was around below this 30-week moving average and this resistance, this support level, which is around 167. So let's assume your stop loss would be 165. And you can buy 250 share based on, because you have 50,000. Okay. So now you see the risk is 8,000 rupees. Now you can only risk 5,000. You only want to risk 5,000. So you have to decrease your position size. So with 200 it is 7,000. With 150 it is 5,300. So you see, you cannot just invest randomly. You have to identify, you have to predefine your risk. Now what happens if the market corrects? Let's suppose market opens next week and it corrected below its 30-week moving average and it starts stage 4, and so panic hits hard than greed in the market. So if panic starts to happen in the market, then you could see some major correction in all these stocks. Major correction. So there is a possibility. So why you're assessing risk, why you're predefining risk? Because you are not sure about the market's future, and no one can know. No one can know what will happen in the market. So you have to always predefine your risk. Of course, based on the structure, it is still bullish, and that's why you are risking. That's why you're buying. So again, every trade that you're going to make, there has to be a risk. Market can correct back whenever it wants. And of course, we have identified it as bullish, but market will act based on whatever it feels like, right? Based on the overall market pattern. It has its own nature. So we cannot know what it would do. We can only assess our risk. It is like an insurance. If market corrects back and starts stage 4, what will happen? If it happens, then with the major correction that it saw in the past, if it corrects that way, you could see some major correction on all these stocks. So you have to be pretty careful when you are considering buying any stock, because there is a risk in every trade. So you can buy 150 shares of Canada Bank with a risk of 5,000. Now, since you have predefined your risk, which is 5,000, and you wanted to buy Canada Bank, so you are ready to lose 5,000. Now, of course, let's look at the probable profits that you're going to make if the market correct back from where it is right now. And let's find out some resistance level upwards. As for the resistance level goes, I could see that this is one of the resistance level, which is around 300. Okay, you see it tried to break out of that level here, and here around this point, and in the past here. So 300 point sounds like a good resistance level. So we could wait up. We can of course see a profit till up to 300. So let's now calculate profit 300. So we see around 15,000 profit. So what is risk to reward ratio for this trade? 1:3, which is pretty healthy. 1:3 risk to reward ratio is the standard. right? So you cannot come in the market and buy whatever number of shares you can buy with that amount, because then your risk, you're not predefining your risk. So risk has to, you need to first know your risk, and according to your risk appetite, you need to decide on how much shares that you're going to buy. Okay. Now let's look at another stock, which is Union Bank. Now one thing, so when the stock price is, of course, for Union Bank, it is trading around 43. So the lower the stock price, the risk is getting higher, because say for a 10 rupee stock, 1 rupee's move is about 10% move, and for a 100 rupee stock, 1% move, 1 rupee's move is 1% move. So you see, when the price is getting lower, the stock price is getting lower, the movement is wilder. Okay, so you have, your risk has to be your risk appetite has to be high enough for you to invest in the penny stocks. But let's discuss a penny stocks here, which is Union Bank, which we have covered in my last video. And as you can see, as the market corrected, it corrected back to its breakout point, which we have identified around 42, 43. So it is trading around 43 rupees currently, and of course it is way above its 30-week moving average, and relative strength is also trading above. Now, if you were to buy, you first need to assess your risk. You first need to predefine your risk, and according to your risk appetite, you have to decide your position size. So it's not that you have to decide your position size first. You have to first decide your risk and then position size. It is very important. So let's suppose you want to risk 5,000 for this stock Union Bank, okay, and you have 50,000. So how much share can you buy? So first, let's discuss how much can you buy for 50,000. 50,000 and 43. So around 1,100 share. Can you buy 1,100 shares? So let's look at here. So for you, let's suppose you want to buy at 43, and based on the risk it has, the moving average, 30-week moving average is trading around 38. And let's suppose we don't want to risk much. We want to keep our stop loss not below its 30-week moving average, but just below its breakout point, which was around 40 to 43. So let's suppose you are putting your risk around 39.75. So below 40, okay? 39.75. Now, can you buy 1,100 share? For 1,100, you have about 3,600 risk. So if you are willing to risk 3,600, you can of course go ahead and buy 1,100 share based on the current market structure. So you are risking only 3,600, and let's look at the profitability of this stock. If you are a trader, you see this was acting as support here around this area, and it was acting around resistance level around this area, which is 98. Okay, now it is of course a very good profitability that it shows. So what is another resistance level that we can find just below this level, which is around 62. You see it was acting as support and then resistance around this area when it broke past of its 30-week moving average. So 62. Let's take the lower level, which is 62. So you see 20,000 profit with 3,600 risk. So it is about 1:6. The risk to reward ratio is 1:6. So now, based on the risk to reward ratio, it is of course looking very, very lucrative. 1:6 reward ratio is very lucrative. So this is an advantage with the penny stock, but then you have to predefine your risk all the time. So if market corrects back, if market goes below its 30-week moving average, if Nifty 50 breaks below its 30-week moving average, and we see stage 4, of course Union Bank and any other stocks will also correct down, right? So since we have predefined our risk, we don't care. So we have predefined our risk, which is 3,600. So if market corrects back, we will lose 3,600. That's fine. So you have to know your risk, and you have to admit that yes, this much of money that you can lose if market acts against you. So you are always predefining your risk as well as your profitability, right? That's how you have to assess your risk to reward ratio. Okay. Since we haven't discussed Nifty Media, some of the stocks from Nifty Media. Let's do that in today's video. Let's look at Nifty Media, because media as a sector is performing very good, right? Last week market corrected about 4.5%, but media sector corrected about 1.91%, right? It shows that it has the strength. Okay, now let's look at some media stocks. So I'll show you Dish TV. It's in my portfolio, and I'll share why. I think we have discussed Dish TV when it was around this area, which was around 23, and I told you explicitly that you have to wait for it to correct back to its breakout point, which it did for the last few weeks, right? And it is trading very close to its breakout point, which was around 16 rupees. Now it's a penny stock, right? So with penny stocks, the risk is very high, very high. So last week when the market corrected about 4%, it corrected about 3%. So you see the media sector is performing better than the overall market, right? So here, if you want to buy Dish TV, which is a penny stock, right? But since I see in social media that people are looking to buy penny stocks. So if you are to buy penny stocks, which is of course interesting and which is of course wilder and adventurous, but then you have to predefine your risk. If you are predefining your risk, your life will be stress-free. And if market correct back, you have your risk in place. It does not matter to you. Okay. So let's assess risk and let's assess position size. So let's suppose you have 50,000. Okay. So how much can you buy with 50,000? 50,000 divided by, so let's suppose you want to buy at 17. So you can buy 2,900 shares of Dish TV. Now, can you exactly buy 2,900? No. So we have to first assess the risk. So its 30-week moving average is around 15.82. So if you want to take a risk, say about your stop loss should be around 15.50, around 15.50 or below that. Your buying price is 17. Let's suppose 17 and 15.45. Okay, 2,900. Can you buy? If your risk appetite is for 4,600 on 50,000, of course you can go ahead and buy. And with that, let's discuss its profitability. If it just reached its recent high, which is around 23.35, let's suppose it reaches to 23, with 4,600 risk, you are seeing a profit of 17,000, which is 1:4. So with penny stocks, you can see some good risk to reward ratio. Of course, we have identified media as a sector that it is outperforming the market. We are not selecting pharma, we are not selecting banking sector, which are currently not performing best according to the other market, right? We have analyzed that sector, which sector that we should stay away from. So this is part of our analysis. So if you are analyzing your things correctly, you would find such stocks which has good risk to reward ratio. So, but then you have to know your risk and you have to predefine your risk at any cost. So if you want to buy Dish TV, you have the picture. If you have, let's say, capital of 1 lakh, you can assess your risk like that. So this is how you have to first assess your risk, and then according to your risk, you have to decide on how many shares can you buy. If your risk is high, you can take higher risk. Then of course you can buy the higher number of shares. If your risk is not that, risk capital is not high, then you have to decrease your position size based on your risk appetite. I hope this was helpful analysis, and now you are well educated to decide on how many shares can you buy of a given stock which you find it to be a lucrative and a good buy. You always have to predefine your risk. Now, what is the disadvantage of not predefining a risk? If market breaks below its 30-week moving average and starts stage 4, panic will hit hard. So panic hits harder than greed in the market. And if it happens, you would see major correction of 20%, 10%. We don't know. But with panic, market will see major correction. Why we take life insurance? So while we know that we're going to live longer, but we have to take insurance for our family member. If something happens to us, then there is backup money for our family. So in stock market, you do not know what will happen. So you have to have your insurance for each and every trade. If you're carrying your money like that, that's when you have a chance of being successful. But I'm going to continuously say this in every video, that you have to have your risk predefined, and then only you can think of a trade. And as I've just shared with you, that your position size will be directly correlated to your risk. Now once you have assessed your risk, that's when you can identify how many shares can you buy based on your capital. Okay, so this is how you have to plan the whole thing. So first, market analysis, then sector analysis, then stock analysis, then you have to identify the levels at which you want to buy a given share, and then you have to find out a stop loss level, a risk level, and then you have to assess your risk, and then you have to decide your position size, and then invest in the stock. You see, this is my plan. Basically, I've just laid out my whole plan. So you have to plan like that. If you are planning things before you're putting in a trade, chances of getting success is much higher in the market. In the market, it's all about probability. So with the probability game, you have to have your plan in place before you can put in a trade. I hope you like this video, and if you do, please like this video, subscribe to my channel, as it will motivate me a lot to create more such content. And I'm going to come with a market analysis video, because I have also seen some major development in the global market. So I'll come with a market analysis, because it is currently trading close to its 30-week moving average. Of course, it has a chance to break out of its 30-week moving average and start stage 4. But based on our probability, it is still bullish. So we will come with a market analysis in in coming days. And I'll see you guys on my next video. Till then, have a wonderful day. Thank you. Bye.